I made a ridiculous amount of money in a very short space of time through property. I invested in my first property ever. It was doing the BRRRR approach, which is you buy, you renovate, you rent it out, you refinance, and then you go again. What's the last one? Repeat. So this is a property approach that a lot of people don't know about. It's really great if you're a beginner or you're wanting to get into the property market but you don't have a giant deposit. This is part 2 of a conversation with Peter West, who is a property expert, and he was the guy that I did this with. So if you would like to learn more about Peter West or you want to get in touch with him about doing this yourself, you can email us. We've put our email address in the podcast show notes. And if you are not sure what I'm talking about and you haven't listened to part 1, go back and do that, because this is part 2 of a very long, in-depth way, basically, of how I made $122,000 in 6 weeks. So if you have any questions, comment where you're listening. If you have a really long question or you don't want to share it publicly, we actually have a Curve hotline, so you can leave a voice note and we can listen and respond in another property episode. So any questions, please let us know. This is new content for us and we really hope that you enjoy it. So here is part 2. Welcome to our brand new property podcast.
Woohoo!
This has been in the works for a long time and we're so excited to finally be able to speak to you regularly every month. We're going to have a property podcast where we talk about home ownership, property investing, and that's whether you're trying to buy your first home, you're trying to buy your second home, maybe you're wanting to buy an investment property. And that is exactly why we're proud to be partnering with BNZ, because they get it, they understand that there's no two situations that are the same.
And having a BNZ home loan partner in your corner, you'll always have the expert advice and tools that can help you make it happen. So thank you so much, BNZ, for helping empower this property podcast.
Welcome back to the Property Podcast, Peter West. Thank you so much for joining us. Oh God, I'm just like, I don't even really know where to start because there's so many things that we need to speak about. But in our last conversation, we kind of covered what the BRRRR approach is. BRRRR, which for anyone who hasn't listened to that, definitely go back. We'll link it in the podcast show notes because it's a good intro into like, what is this approach to property? Why have we even got Pete on? Who is this random man on the Curve podcast? Yeah, so basically, Pete and I worked together over the last 6 months. I guess probably the actual time we were doing it was within a 3-month period. But yeah, we used this approach. We bought a property and I thought it would be quite cool to speak to that process and how we chose it and whatnot. But I think before we get there, it would be great to do a proper kind of pros and cons list on why this kind of property, what's really great about it, what's not so great about it. So people, as they listen to my experience and what I've done, they can kind of figure out if this would be right for them.
We'll go through the pros and cons of both. So firstly, before I get into it, I suppose I'll just caveat with there's no right or wrong. Depending on what your situation is, what you're trying to achieve, will depend on which strategy is right for you. So no shade on the passive approach. That's not my
Do you think
approach.
People will come at you? Do you get
people do get a little bit oh, you're so one-eyed. You're just...
Oh my God, can you just get a life?
Yeah. So...
No,
people are quite protective. I guess people are protective. Like, for example, Opus Partners, who are a really good company, and Andrew and Ed and everyone else that works there, they specialise in new builds and they help people generate money through new builds.
Got it.
And that's a perfectly fine strategy. You know, Andrew's got a property portfolio of 45 properties or something like that, and he's done that through new builds, as far as I understand. So, but different time.
Different strokes for different folks,
exactly.
etc.
So that's a massive caveat so people don't come at me.
Also, can I just say, I think the same thing's true in the stock market investing space, because for ages, Vic's always kind of spoken about how there's a lot of people who believe in just buying really low fee ETFs and investing, or just tracking the market. And then there's people who have made a whole living out of actively trying to invest in things that, and sometimes that works for some people. Sometimes you like a combination of both. You've actually had experience doing all of the different types of property investment, and this is just the one that we're talking about today. It's not to say the other ones aren't valid.
Bang on. So in terms of the passive approach, the pros of that approach is you get a really nice, freshly built house. So you're not having to deal with any maintenance. The shower's not going to break down. The guttering's not going to be an issue for 5 or 10 years. So it's really low maintenance, really low input. And you don't have to do that much due diligence on the property. You don't have to check if the piles are okay. You don't have to check if the cladding's okay because it's just been built. So it's quite a low input in terms of your time and energy needed to buy a property like that.
It makes sense if you think about the idea of a new build. They're starting from scratch. They're using new materials. It's not going to be leaking. There's not going to be any fundamental things wrong with it. Well, I assume if it's been well done.
Yeah, you still need to check those things, obviously, but it's a lot more straightforward, and it would be odd or bizarre if there were defects that you found, right? And so that's some of the pros for that type of property. You can do it remotely. You can buy something like that overseas because you don't really need, if it's an investment, you don't really need to come and see it. But the cons with that type of strategy is that the day you buy that property is the nicest it's ever going to be. It's only going to get more run down.
That is such a good way to put it.
Yeah. It's only going to get more run down by tenants, time and stuff like that. So it's only going to get worse over time, and you can't do anything to that property to make it nicer. It's the nicest it's possibly going to do. So you can't forcibly appreciate it, and hence you're reliant on the market, which is a con. It's somewhat out of your control in terms of what that value of that property does.
Also with the new builds, because isn't the idea of supply and demand so important? So if there's 500 of the exact same apartments, is there a chance where there's so many that it's hard to rent out because they can't find the right tenants? Is it there's no real uniqueness to it? So when it comes to selling, if 25 in the building are selling at the same time, it's kind of, are all of those things as well potential cons?
100%. Speak to anyone who's tried to sell a townhouse in Christchurch for the last 2 years, and they won't tell you a pretty picture. It's been pretty tough for that exact point because there are lots of them out there, so it is pretty tough. And that's another con as well. When the time does come to sell, it's going to be pretty hard for those points that you've just highlighted there. There's lots of them. They're all pretty similar. And so why would someone pick yours versus someone else's? Just down to price, really, which is not the position that you want to be in.
The other thing, when you said, it's at its kind of tip-top shape at the point in which you buy it, I think that's such a valuable point. It's kind of like a car. You drive it out of the dealership and it immediately loses value. And obviously the difference with a property is that you've got the capital gains over time if you hold on to it. But it's not a situation whereby time goes on and you add value, you can actively increase it. You're more at the mercy of the idea of holding for a long period of time if you want to make money, right?
Yeah, correct. So if you purchase something like that in 2021, it's gone down in value and you can't do anything other than just wait for it to come back. But if you bought a bit of a do-up in 2021, you could do it up and then maybe it would be now worth what you paid for it or maybe a little bit more. And the other, I suppose, con is around cash flow and yields. Typically, these types of properties cash flow negative. So you have to put in money to top up the mortgage, which is not what you really want to be doing. You buy an investment property, so ideally it pays you. And then the downside of it being cash flow negative is it's quite hard to go and then borrow for the second or third property because the banks in their spreadsheets say, well, you can't afford it because you're having to top this property up. So how are you going to get a second or third mortgage?
But
so
hold on, sorry, cash flow negative. Can we pause on that for a second? Yeah. So that is the idea that to service it, the rates, the interest, the mortgage, everything is what you can get for it in terms of how much you can rent it out for doesn't cover everything. Is that the general?
Correct, bang on, yeah.
And is that always the case with new builds or just most of the time?
I would say most of the time. There might be some unique new builds out there that are sort of dual key potentially, but by and large, definitely in Auckland, it's going to be cash.
So dual key, sorry?
Dual key is sort of it's you buy one apartment, but there's actually two apartments in there, if that makes sense. So you live in one side and you rent out the other side. So they're really good for yields, or you'd have two people in there.
Okay.
But by and large, someone might shoot me down again saying I managed to get a cash flow positive new build, but typically they require a top up.
What we are looking for with these podcasts and content is for you to absolutely rip Pete apart. So if you have got any feedback on his approach, we're open to hear it. In the comments, feel free to go hard.
I've got thick skin. Bring it on.
I love it. Okay, so these are all cons of a new build versus buying like a rundown shitter that you have to do up.
Yeah, correct. So over to the sort of more active shitter that you need to do up. So the cons of that is, I suppose, there's a little bit more risk. You're buying a house that needs work, so there's a bit more. You're gonna have to put more cash into it. There's a risk that renovation costs more than you assumed, and you have a budget blowout in that sense.
Which happens a lot if you don't know what you're doing.
Can happen, yeah, absolutely. If you go into it with poor planning or poor knowledge, then you definitely run a risk of that blowout happening. There's more maintenance required on an older home. You know, if a house has been there for 30, 40 years, the gutters are probably going to need to be replaced. The roof is probably going to need to be replaced shortly. So there's more, things are a little bit more tight. So those are some of the cons. In terms of the pros though, you can pick them up for a lot cheaper. You can renovate them so you can forcibly appreciate that value. So you're not so reliant on the market to take care of it.
Forcibly appreciate it's quite aggressive. Do you think that we could
Can
maybe
we
call it
that?
actively adding value or something a little bit more positive?
Yeah, it's a bit of a wanky property
It's
term,
so
isn't
intense.
it?
Yeah.
I've been too deep on the property stuff. What did we agree we're going with?
I think we go with actively adding value or actively increasing the value.
AAV.
Yeah, AV. You're AVing.
So we're going to AV it. Actively adding value, which is, doing all the good stuff, you're painting and etc. Your destiny is more in your control versus father time waiting on the market to take care of it. They also cash flow positive. You can pick up a house for $300,000 out in the regions, but you still achieve really good yields for that property, which means, well, A, you don't have to top it up from your hard-earned cash, and then B, it better enables you to build a portfolio because you can go to the bank and potentially get the borrowing for the second and third property, which is really key if you want to build a portfolio.
That's kind of the main part about this, which is great. And I think that's, anyone that has a new build, I'm sure it's a great investment. Like, we're definitely not trying to say, like, you've had a shocker, you shouldn't have bought that at all. It's just realizing that there's different ways you can make money through property. And some of those mean, like, maybe you start a WhatsApp group called Property Moguls, like me, Pete, and my friend who have bought a house, because our plan is to do this and have a portfolio of properties. Like, I'm not in a position where I want to be or need to be owning a first home that is at a spec or in a location that I want to live in. But there's also other ways of doing it, right? So, like, let's say you've got for your first home and you're living in a beautiful place and whatever. I mean, are you able to also borrow against that to go and do a smaller investment property somewhere else?
Yeah, correct. Which is probably a nice segue to talk about rent vesting, which we haven't touched on, but we can, which is effectively what you're doing. And so rent vesting is where you don't own your own home, but you...
Rent vesting?
Rent vesting. It's a thing. It's a term.
I didn't know
it's
it.
Like AV. It's
rent vesting. So it's like...
You're renting while you're investing.
Oh, I like it.
Yeah. Which is, you're a rent vestor.
I'm a rent investor.
So we are trying to turn you into the moguliest of the moguls.
Imagine me in the future, just like a photo of me with like 40 houses behind me. Like, you can do it just like me.
It's going to happen. Start visualizing. Rent vesting. So that's where you don't own your own home. You continue to rent, but you invest in property outside or maybe even the same town where you live. And that is, I think, a good financial decision. Sure, buying a home is still a good financial decision. You're going to do all right out of it if you hold it for long enough, right? But also rent vesting is also an option. So you can skip the step of owning your own home and then borrowing for a property, because most people do, the typical approach is buy your first home, wait for it to go up in value or renovate it, and then take that equity and go and purchase an investment property. If people get into property, that's the typical or most common process, but you can skip that step, continue to rent, and then go and purchase an investment property, which is what I do. It's an active decision that I've made. I don't want to own a home yet. I don't need an expensive home. I'm happy to, live in a relatively small home, a 1-bedroom apartment with my wife, pay cheap rent, and then use my capital to invest in properties out in the regions. So
a really great analogy for this is if you buy an expensive home, and let's just say, which is definitely a New Zealand dream. It's like, to be honest, it's a dream all over the world. The idea of buying your first home, living in this place that blah, 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 blah. It's so interesting. And I would say this is the biggest shift when it comes to property and investing that's happened in the last probably 30 years, which is it used to be that you would buy a home, you would hold on to it, and because you would buy it for so much less than, at the moment, I think 2024, those stats are that like the average first home is like 7.7 times someone's income or something, whereas it didn't used to be that high. So buying a really nice property to live in and make capital gains through that was a really great way to create wealth. Whereas it appears to me now that like the most clever property investors or investors are not living in their beautiful homes. They're doing exactly what you're doing. And it's kind of this like interesting mindset switch of like, I'm not putting myself in the best asset or the most beautiful home because I'm thinking about my long-term wealth and I know I can make better returns by putting that money elsewhere, which is so interesting. And I don't think a lot of people have had that moment of realization that that's actually the case.
Yeah, I don't think people stop, and rightfully so, I suppose, because it's been drilled into us probably from a young age, get on the property ladder. But people don't truly stop and calculate, okay, what is the opportunity cost of that $1 million mortgage? What does that mean I can't do, or having that
100%, because so many people have these giant mortgages and then they can't do anything else.
Yeah, correct. Bit of a golden handcuffs.
It is a bit, isn't it?
And so I was lucky enough that I read resource, and what hit home for me, where I got the idea, I got it from Opus Partners. They got a podcast. What hit home for me, Andrew, I think has like 40 odd properties.
Whoa.
Doesn't own his own home. And I was like, ooh, okay, if that guy's, doing that, then that's probably a pretty good idea. And so, yeah.
Just to clarify, it's not that he doesn't own his own home. He doesn't live in a home he owns, right? He's still renting for his home.
Correct. He's not homeless.
Yeah. Let's just clarify the fact that he does own 40 properties. So he does own property.
He does own properties, but
he chooses to live in one that's
to
not.
Rent. Yeah. To rent rather than going and buying a whatever $1 million, $2 million mortgage.
I've been looking at some $2 houses too.
That'd be nice. So yeah, that's rent vesting, which is an option for people out there. Coming back to I think what we touched on in the first episode is still very much achievable for people. You don't have to be able to go and afford to buy a 1.5 or $1 million mortgage or a house. Sorry. You can still get in whilst renting, get on that ladder, use that gain that you achieve through your investment property, and then maybe buy your dream home if that's what you want. The main pros for me with the active approach is the outcomes in far more in your control. You're not relying on the market, and you can continue to build a portfolio because they're cash flow positive. So
when we first started talking, I was visiting a friend of mine in Hawke's Bay, and her husband is a commercial real estate agent. I was telling him about this idea that we'd been talking about, and also my friend was saying, like, basically both of them were saying that, like, be really careful. Be really careful, Soph, because, by the way, this is not me taking the piss of them. I just realized the tone in my voice is so rude. But basically they were like, a lot of people don't make money in this way anymore. Be really careful. Like, renovating and like adding value is not what it used to be. Don't think this is a surefire return. What would you say to people like that who are feeling skeptical about the idea of like the heyday of property's gone, making money and like, adding value and selling on is a dangerous and potentially like you might even lose money, let alone not gain it?
Firstly, I suppose a generic comment, and no, once again, shade to your friends because it's probably coming from a good place. I am always conscious of who I take information from and absorb information. And a personal little anecdote, my uncle is really against property.
Really?
Even though he's made lots of money through property.
Why?
He never told me why. He's like, property's going to crash, we're in a bubble. And he's been saying that for the last since 15, 20 years now. And so that always put me off property because I looked up to him because he's done quite well financially and always put me off. And then one stage I was just like, nah, I've done my own research now. I've got enough facts. And I've jumped in and I'm glad I did it. But that probably put me back because I put quite a bit of weight on their opinion. So who you take information from and influence you is obviously really important. Not to say that your friends aren't in a position to provide you that commentary, but that's just a generic statement. But in terms of adding value, it is, a pretty tried and true method. You obviously can get it wrong if you overpay for the property, or the renovations blow out. Of course you can get it wrong, but it's, I suppose, aligning yourself or using people with the right skills so you reduce the risk where you can and go into it with a comfortable level of risk. Flipping is a lot harder to make money from, 100%, but you're holding a property for 20 years, and I've never heard someone, lose money on a property that they've held for 20 years. So yeah, as long as you're holding it for the long term, you plan well, you should do okay out of it.
It's so interesting because actually I've had so many people lately, and I don't know if this is like millionaire chat, because these are my friends who are definitely in positions where they don't need to be investing to grow their money. And they've, said things like, oh, I think I'm going to sell my properties, or like, I'm not really into property investing anymore. Like, what? Do you know what it feels like? And I don't even know how to explain it. It almost feels like, because now lots of people are doing it, it's become this uncool asset or something.
Really? Okay, well, good. Keep selling. I'll
yeah,
I'll
I'm like, I don't know what it is. And that could be me 100% just being like emotional about it. But I just feel like there's been quite a few people lately who've said things like that, where I'm like, is this just because other people are able to do it and it's more common now? Like, I don't know what their thoughts are around why property is not a good investment. But for me, and like with my experience with you, having made 125,000 in
5 weeks.
5 weeks. Like, I've never made that much money ever in my life. So I don't know if it's just that they're playing with bigger numbers, and for them the amount they can gain in other assets is more, but I don't know.
Depends on the type of asset they may have. Like if you go and purchase a house in Ellerslie for $1.5 million and you rent it out for $700, $800 a week, it's not a particularly good investment. So I could absolutely see where someone who's gone down that path and hasn't followed a BRRRR approach out in the regions would feel that way. And unfortunately, a lot of people do go down that approach because they think, oh, it can't go wrong. Do you know what I mean? So they're not putting that much thought into it about the yields and what they're achieving. So absolutely, the vast majority of people, and that's why the vast majority of landlords in New Zealand own one property. They don't go beyond that because the serviceability and the ability to recycle the equity. So I could see how a lot of people do feel that way, but it's making sure you choose the right strategy, which I'd like to think that you have.
Yeah.
And so you're in a position that you're not having to top it up, and you're still happy with the return on your investment.
You mentioned just before that flipping is like potentially, could go very wrong. One of my friends who is also a hairdresser, she's amazing.
He's looking great.
Thank you. Thank you so much. I've had some really good feedback on it lately. Anyway, she was saying that her partner, they did a flip recently. Her partner's dad had done flipping for years, was really experienced, but they lost $250,000 on this property.
Ouch.
And I was just like, I cannot imagine losing that much money. Even 5,000, I would be gutted, let alone $250,000.
Yeah.
So would you say flipping is potentially one of those things that is not like come out of the gates ready to go thinking that you can necessarily do a flip well, and actually it probably requires even more guardrails and experience to do properly?
100%. I wouldn't recommend anyone go flipping, and that's coming from someone who is a flipper. It's hard. Like anyone who thinks it's easy, it's not. It's really not. Like me in my day job, it was so much easier to make money, turn up to my 9 to 5, take my check than what I'm doing now. It's really not easy. And it's been a particularly hard time over the last, let's say, 3 years with the peaks and troughs that we've had in the property prices. So if you purchase something in 2021 just before it fell off a cliff, then you would have been absolutely burnt and hurt from that. And so it has been tough because we just haven't had a steady rise since then. It's sort of been up and down. So trying to deal with that has been tough. But it's a little bit tougher for a few different reasons. There's far more costs involved when you flip. You have to pay the agent's fees. You have to stage the house. Your finance is more expensive because you can't get money from a bank. You have to pay GST. So there's a lot more costs which are incurred when you're flipping. You also then have to convince someone to buy the house at the end of it. So you have to really understand exactly what that person wants, exactly what that person's willing to pay for it. Versus when you're buying and holding, you just had to convince someone to rent that property out, which is a much smaller decision versus someone asking someone to part with $800,000. And then you've also got the changing markets that I just referred to. If the house prices change in that period that you've held it, which is completely out of your control, then you're going to get stung, which is probably potentially, without knowing the detail, what happened to your friend. The market changed. If it goes down 5%, that's a massive amount over $1.5 million property. So it's definitely risky, and you don't get an asset out the end of it. So, I wouldn't necessarily recommend it. It's not a tool to generate wealth, but there are pros to it. You can do more deals. You learn more.
Look, I think most people listening flipping is probably not for you. I mean, I don't know everyone's situations, but I'm assuming it's probably not the one.
No.
Also, is it right in saying that unless you can be actually the one physically helping with it in terms of your labor, is discounting what you're spending on contractors and laborers is another way that, like, if you're actively involved, it probably makes it a more potential for it to be financially viable?
Definitely, the more sweat equity or the more time you put into it, the less it's going to cost. But there are full-time flippers out there who don't do any work themselves, so it can be achieved without doing work yourself. It's obviously just a little bit cheaper and easier if you do work yourself. But some of the work. Are you a registered builder? Can you do the plumbing? Probably not. So there's only a limited amount of work. I just imagine
myself YouTubing like how to pull carpet off the ground, like not a clue.
And if that's not what you enjoy, then you're not going to have a good time doing it either as well. Do you know what I mean? So it depends on what you enjoy.
Pete's current situation is like essentially living in this, like, is it a blow-up mattress on the floor?
A foam mattress.
A foam mattress on the floor. Like it is grim.
Yeah, and it's not that glamorous. Like, I've been camping in that house for 12 weeks now. There's no power. There's no water. So I just camp. I eat takeaways every night. I have to go down to the local public toilet. So it's pretty grim. And so that's like a reality of flipping. But there is this sort of romanticism, is that a word?
It is.
About flipping. I think people said, they bought it for 400. They sold it for 600. They just make 200 grand like that, which is not the case. They ignore the fact that you spent 100 grand renovating it. You paid 15 grand GST. You had to pay tax. You had to pay the stage of the agent, and you got left with 20, 30 grand at the end of it, and a lot of your time and energy. I've been away midweek from my wife. God knows how you do it with kids. So it's not easy.
And also imagine living in the house you were trying to flip. Can you imagine it? Like, as in you're living in the one you're flipping, but you don't imagine if you had a family and you were trying to like live on a construction site. It
wouldn't work.
It'd be so hard.
Yeah, it wouldn't work.
It wouldn't work, would it?
Yeah, health and safety.
Yeah, okay.
I've already had nails through foot. You don't want that through kids.
Oh my God, you stood on a nail?
Yeah, health and safety, I could probably improve my processes. Getting work boots would be sneakers.
You don't have them?
Nah, I was just using my sneakers. So
oh my God.
There's some room for improvement in that space.
Oh God. Okay, so then have you ever had any disasters or like really big learnings, whether it be a flip, whether it be the BRRRR method? I mean, you've obviously not been put off property and you've done well overall, but like, have there been some serious learnings, or did you just research the shit out of everything and actually manage to avoid any major
No, there've been a shitload of learnings along the way. People can tell you things, but until you experience the pain yourself, you don't really, like, people, you're like, oh yeah. And then you actually go through it, you're like, yep, I see what they were talking about. And so there's been lots of those moments. I'm yet to lose money on a property, but there's definitely...
Shit, yeah, that's so good. Where's some wood?
Touch wood.
Touch the table.
But there's I've definitely like could have made more money if I had done things differently, for example. One thing is around staying patient. which is quite generic, but I've had buyer's remorse before. And we talked when we started this process around, hey, stay patient, Sophie. I mean, we got lucky. It took a couple of weeks, but I said, this could take 3 months and we just have to slog it out and stay patient.
I think that was I almost like gaslit myself into being like, you're not going to get anything. Like I did the extreme of like expectations are like lower than the ground.
That's good.
Because I didn't want to get my hopes up. But it's so hard as soon as you've done the work on something, like, you did so much of all of it really. But yeah, the idea of doing that and then the numbers not adding up and therefore you deciding not to go ahead with it, which you have to do. It's like if you're researching a stock or a company or a fund manager, you do all this work and then you find a red flag. You have to listen to the red flag, and that comes down to the whole patience thing, right? It's like you put a lot of work in, but it's just not worth going ahead with something unless every single thing lines up, and sometimes that takes time.
It's kind of like dating. Like, yes, you got on a first date.
Oh my God, it is.
Invested in the dinner, a few drinks, a few red flags, and yes, you've invested, but you just got to walk away because
So right.
world of pain if you don't.
You've just, do you know what? Actually, Pete and I and his wife Michelle, we had dinner not that long ago, and we were talking about dating and if you should do the whole like, hey, nice to meet you, but no, thank you.
Yes.
And I was so impressed that Pete's answer was
Yes.
yes. That is so true. It's like, why waste anyone else's time? You've already invested your time and money in spending with each other. If it's not the one, it's not the one.
Just move on to the next.
Yeah.
More fish in the sea.
Thank you. Nice to meet you. Bye. You're right. It is very similar to dating. And you get excited and you're like, oh, this is great. This is the one. Let's buy this one. Let's go on a second date. And then you're like, oh, we've seen a red flag. Oh, we've been hit by another. And then it's like, you have to listen to it.
It is key managing the feels or, the emotions in the property sense, because you don't want to get connected to a property,
which is so hard
because it's hard to walk away, but you got to be led by the numbers. So it's putting that emotion aside. Numbers say, computer says no, move on. So my lesson was around staying patient with property, and my anecdote or example is I was looking for a property, I don't even know when it was, 2021, and probably been looking for 2 or 3 months at this point, and I was getting pretty frustrated with the process, and I just bought something. I did all right out of it, but of course Murphy's Law, like the perfect property came online like 3 days later, and I couldn't do anything because I already purchased a property. And so I was sort of kicking myself because I think I probably would have made maybe $100,000 on the other property more.
Oh, that's devastating.
And it was just, buyers, what I call buyer's remorse. You're like, now I'm stuck with this property, which I was kind of happy with. So that was one lesson around just staying patient, sticking to your numbers, because if you're going to hold it for 20 years, who cares if you bought it in February or June? You're not going to remember that in 20 years' time. Do you know what I mean? It's such a small, it feels like a lot of time at the time when you're like looking through Trade Me every single day and keep getting disappointed. But stay patient.
Patience is a virtue.
It is.
And numbers don't lie.
No.
Well, this is kind of what happened with my property, our property.
Yours and
We've been under strict instructions. We're not allowed to say my friend's name, which really sucks. Anyway, so we had a situation where this property came up. Pete had been like, bless his heart, really trying to teach us the theory of like kind of what we've been talking about already. And then all of a sudden, this property came up and it was kind of like all guns blazing. Like all of a sudden, Escalona came up. And we were like, oh shit, we're going to have to ditch our theory sessions and go straight into action mode.
Still need to finish those.
We went full steam ahead and it was ticking all the boxes structurally. It looked like a good house. It looked like it had the bones of like what we needed. It didn't need a big roof replacement. Essentially all the things that we spoke about, in particular the first episode we did with you, which if you haven't listened, it might be helpful because we're not going to go over the same thing again. But essentially it didn't need
didn't need anything with the piles. Cladding was in good nick. Guttering was in good nick.
It was
just tired. Hadn't had anything done to it for 20 odd years.
It was a bit exhausted.
Yeah, it was.
It had a big
tired.
career.
It had a good life.
Yeah. But it was not in tip-top shape.
A little bit hungover.
Yeah, definitely.
Bit dusty.
And let's talk through how we figured out the numbers based on the BRRRR approach. What did we figure out in terms of what we needed to pay for it, all of that?
Yeah, so the process was, I'll go and check it out first and foremost. That's what I do. Just obviously you can tell a fair bit from the photos, but I've been to many places which look good in photos and you turn up and it's crap. Yeah. Houses are great for catfishing. Beware, people. So went and checked it out and it was pretty much perfect in terms of what we're looking for. So next step was to get the reno team through. Well, step one is actually figuring out what we're going to do to the property. So I came up with a plan of, okay, let's put a bedroom here. I think we can open this space up by getting rid of this wall. Is it structural or not? Figuring that stuff out. And then getting the trades out on site and getting a quote for them for all of that work. We then figured that out. So we knew what it was going to cost us going into it. And I think our budget was 85 grand. And then it was figuring out what we thought the property was going to be worth at the end of it, which is looking around the area and figuring out what other houses have sold and making a conclusion based on that.
So what that looks like for anyone that's like, what are you talking about? It would be, so Escalona was in a particular area in Whangarei, which is up north in New Zealand in the North Island, and basically it was, okay, well, what sold in a similar area? What does it look like? Are some of these places like in a better condition than ours, or what we think it's going to look like at the end? How much did they sell for? And really trying to have a educated guess on what a facelift done to this house that we're buying would mean it would be worth at the end.
Yeah, correct. Because when you value the property at the end of the process, when we get the value back out, that is exactly the process that they go through. And so effectively, we're trying to be a valuer. We are trying to say, okay, what is this property worth? And so we follow the same process that they follow, which is looking at the sales on that same street or a couple streets over. This house was similar, but it had a pool and it went for 100 grand more. So we're gonna discount ours. Ours is only going to go for 600, for example. And you go through that process and come up with a conclusion. And there's a bit of skill and nuance involved in that, but being able to come up with a really or being really confident in what that figure is key. And for Escalona, I think we concluded it was going to be worth 660 to 680. I think was our range. And so based on that, we worked backwards from there. Sorry, 560 to 580.
Okay, so in terms of, just quickly, this is incredibly unrelated to property, but I just need you to know a fun fact that I think is hilarious. So Escalona, you know how we're trying to like say it with a Spanish accent. Do you know the only reason that Spanish people have an accent?
Go on, enlighten me.
So there was a king and he had a lisp and he forced everyone to speak with a lisp. Isn't that hilarious?
I like that from him.
Same. I'm like bold. Like generations later, he was like, gracias.
If only he knew.
So back to the property.
Yeah.
We realised that if we wanted it to be worth about 580 at the end, after we'd done the renovations, and we were only going to spend a max of 85,000 on the renovation, it meant that we could only buy the property for like 400,000.
Yeah, I think going into our I'll use the word our auction.
Yeah.
We agreed that 405 was our max price.
Yeah. And I said to the others, I was like, come on, guys, what about if it goes to 410? I reckon maybe we just do it. And they were really strict with me. Both of them were like, nah, this is our goal. This is the target. We're going for 100 grand uplift. So that means if we're going through all this admin, we want that happening. Otherwise, you may as well just not bother.
Yeah, we gave you a bit of a telling off.
Yeah, I was keen to just let like, that one slide.
Maybe 50 grand's still good.
I know, I actually said that.
Quote unquote, Sophie.
Yes,
right.
I did, you're right.
Which, it is, you're right. 100%. 50 grand's great. But it's not great when you compare it to 100, which was effectively what we knew you could achieve. So there's an opportunity cost for settling for that. Don't settle.
Don't settle, guys. There's
Lots
so
of relationship
much.
advice.
The catfishing, don't settle, be honest and move on when you've realised it's not right for you. Like there's lots. Very, God. So basically, let's just paint the picture of what was going on with this auction. So we found out that the property was going to auction, which in itself is actually, I mean, I don't know if that's a good thing or not, but I was quite nervous about the idea of auction.
Typically not. That's the least preferred sale methodology.
And why is that?
Firstly, with an auction, you have to spend money, time and energy to get ready for that auction, and you've got no guarantee of outcome. You know, if you have to spend time getting the tradies there or purchase a limb report, you can potentially spend $1,500 before you even turn it, building reports.
And heaps of time.
Emotional energy before even knowing if you're going to get the property. Versus in a negotiation, you can get the property under contract and then start to spend the money. And then you know exactly if it's worth investing any time and money or not. Do you know what I mean? So it's a shame because you have to spend a lot of time without any guarantee is the main downside.
And the other thing is, you know, like it's live, it's happening. You're not just like, you don't have the time in between to think or be like, let me just phone a friend, although I did have you on the phone. There's a
competition factor as well.
There's competition.
When you get two people in the room, I've been guilty of it. You turn up to an auction going, I'm not leaving today without this property. And if the other person also turned up with that same attitude, you can see what's going to happen. You just both bid, and I've been in places where I'm like, oh, I'm 50 grand above my max here. And luckily, in those situations, I've actually lost. But afterwards, I was a bit like, whew. Like,
you get swept up in the excitement.
Thank God I missed out on that, because I'd be talking about buyer's remorse. That would have happened. And so I've learned some skills around how to make sure that doesn't happen. But that is another downside as well.
And, you know, just to bring it back to dating, you know, since we're on the theme of it.
Keep it going.
Let's just use the example of you find out that someone's dating 3 people. All of a sudden you're more keen. As soon as someone is like, do you know what I mean?
I thought you were going to go with lucky you figured that out and moved on because they're not the one you want. Red flags.
Oh, that's quite good too.
But supply and demand.
But supply and demand, you always want what you can't have. Do you know what I mean?
Yeah, 100%.
Like as soon as you can't have something, you're like, nah, I want it. And you're like a dog with a bone.
It's a schoolyard. There's the single jock. Yeah. Girls are fighting over him. Yeah.
Oh, God, I saw the jock from my primary school at an event while I've been home.
Or is he blowing out?
Do you know what he said to me? I feel like I shouldn't even say this because it's probably going to get back to him in some way. Not that I've even said who it was. Yeah. But he was like the hot boy at our primary school.
We need an investigation. People go, figure out who this is.
And I saw him at this event and he literally said the words, so are you still doing that podcast thing? And I was like, you fucking wanker. I was like,
yeah, we just raised $1 million.
Yeah, I was like, fuck off. Go and take your cricket bat somewhere else.
Those cricket people. That narrows it down.
I bet I'm going to get so much regret from saying that. But basically, yes. Okay, so I feel like it would be quite helpful to talk about the idea of auctions. Because for me, being able to literally phone you and be like, what do I do? What do I not do? Help me. Lots of people don't have that. And I hear so many stories of people going to auctions and not getting lucky or, you know, spending too much or whatever. And I think there was some really practical tips that you gave me in terms of like what to say, what not to say. And I would love to talk about that.
Yeah. So firstly, I suppose we had a bit of a strategy session before the auction. And I think that's important, like having a plan before you go into it. That can obviously, the plan can be blown out as soon as someone bids straight away more than you're willing to pay for it. But at least have a plan going into it, which we did. And some key things that we sort of did a bit of what if planning. We
actually did contingency plans. Yeah, we did BCD, didn't we?
If this happens, what are we going to do?
And I wrote it all down.
If this happens, oh, you're a great student.
I was so
studious.
Paying attention, and I was so nervous for it.
Well, it's your first auction. It was your first auction, right?
Oh, it was like, and all the stuff that they say, you're like, oh my God, what is this? Like, when's the time to bid? Like, it's very overwhelming.
So we had an auction 101 of like, this is what's going to happen. Because it is quite a nuanced process. And, you know, if you didn't know what a vendor bid was, you'd be like, what the hell is going on?
Yeah, I didn't even know what the word vendor was.
Yeah,
vending machines. What's going on?
There's just lots of terminology. In property, that being one of them. So we had a bit of a strategy session. The key things we agreed was, well, what happens if no one else turns up to the auction? Because we didn't know how many people were going to turn up, right? And so the agent was saying, oh, we're expecting 2 or 3. And so when we turned up and we were the only ones, we're like, oh, okay. But at least we'd actually talked about that beforehand. And so we talked about, okay, what is going into it, we knew what our max price was. when we were going to stop bidding, then what our max price was if it got to negotiations, and then we had a price we agreed if we were the only ones in the auction when we were going to stop bidding. And that's all around your negotiating power and what you can and work with the vendor. So
well, why don't we use the example? Why don't we actually use my example? Because I think sometimes the hypotheticals can sound a bit weird, but you said don't bother even, like, you know that you're trying to get to around the 400 mark, start in the threes. Like, don't fucking spend, like, especially if you're bidding with yourself, because you're going to be doing it for ages.
Yeah, and I've heard that. And once again, in auctions, I suppose a caveat, I'm all about my caveats, I guess. The person who bids last wins. So, like, yes, you've got these strategies, but ultimately the person who bids the most is always going to win. So,
and there's also only so much you can control. But I do think talking about this was helpful for me.
But that strategy which Sophie just mentioned of being passed on, or someone's told me about that, is bid as close to your final bid as possible. Because if you start with $100,000, you get the emotions going because the next person goes 120, you go 140, and it starts the gamification. But if your top bid is 350 and you know that, just straight away go 330. You cut out a lot of the emotion. This is what I've been told. I don't have.
I feel like I started at about 320 or 330. Or 40 or something. Like, I didn't start super low.
So to give specifics, like you mentioned, we agreed that if there was nobody else in the auction room, your max bid was going to be 375.
That's
I think,
right. Yeah.
Like mid to upper threes. We agreed that if there was someone else in the room, we were going to stop at maybe like 400, and then our absolute walk away price was like 405.
Yeah.
If we got into a negotiation.
And to be honest, in hindsight, if we had other people there and we'd stopped at around 400 and then it had gone into negotiations, there's no way we would have got it. Because it was too close. Like, and this is the other thing that Pete shared with me, which I think is such good insight, is like, the idea is that you, particularly with a negotiation, you want there to be a negotiation. Like, it's a psychological idea as well of like meeting someone in the middle. Like, you don't want someone to feel like they've had to move their goalpost heaps and you've not done any moving.
You need to give them something, like, because it's not a nice feeling if one person's giving something and the other person's not, right? Just like a relationship, 50-50. And so that was really beneficial. Of course, we knew you could go higher, but if you stopped at 370, then the vendor at least felt like you were giving up. And we communicated that. And I hope I'm not giving too many secrets away here. Hopefully
it's
too
good.
many agents don't listen to this.
Away.
But we said, coming into this auction, our goal today was 380. And so we're already at our max, but we want to get a deal done. And so we're willing to go up to 400. And that, I think, helped because, for context, we were all on a Zoom call. And so Sophie was doing
it was fun but scary.
Sophie was doing the bidding on the phone and did an absolute amazing job. And myself and Sophie's mate, who is 50-50 in the property, was on the Zoom call.
From Prague on holiday.
He was having beers, wasn't he? Smashing beers.
So good.
Probably smashing darts and all sorts. But yeah, and so we turned up to the auction and Sophie was the only one bidding, which was stroke of luck. Don't know if it was a bad campaign, but just absolutely our, complete luck for us. And so bit of vendor bidding, which is where the vendor bids against yourself.
Well, I think this is worth saying because I didn't know this until you said it.
Yeah.
Pete was like, if you're the only one, there will be someone else that's kind of like counter bidding. Their bids don't count, but it's just to help move the auction along.
For the vendor.
Which you just don't even know unless someone tells you that.
Yeah, and that only happens below the reserve. So as long as they're bidding, we knew it was below the reserve. And we stopped at whatever we agreed, 370 or something like that.
375, I think.
And then it went into the longest negotiation I've ever been a part of.
Really?
Yeah. That
it
went
was
on
about
for
20 minutes.
It was longer than that.
No, I was filming.
Was
the
it?
whole thing was
20
about
minutes.
half an hour. Yeah.
Felt longer. Felt a lot longer.
It did. It felt like ages. There was lots of
There
gaps
was
between
at least 2 or 3 back and forwards of like, okay, we can go 390. And so for context, they disclosed that the reserve was 480.
Yeah, that's right.
Which I said to Soph, like, at that point, I was like, I don't think we're going to...
I actually remember seeing your face and you were just like, oh damn, we're not going to...
Just disappointed, like, I don't think we're going to get this across the line.
Yeah.
And for context, going into this auction, I also told Soph and said person, like set your expectations. I was like, I think it's more probable than not that we're not going to get this property.
Yeah.
Like it's in a nicer area. There's going to be a bit of competition, and so I was quite surprised when we were the only one, but then the kicker was when they said the reserve was 480. So I thought, we're not going to get this, but we went into negotiations and backwards and forwards, and you managed to. It was quite fun. Managed to haggle them down. So I was on the Zoom call. You would like mute the person on the phone.
That's
like,
right.
Hey, what should I say? And we were like, go 393.
We were like on the chat on Zoom. We were like muting ourselves. I was like, I'm going to do the classic thing where someone accidentally picks the wrong phone up and it's like, oh, fuck, I'm talking to Pete on the other line. And then Pete's like, it's me. I was like, oh.
If you haven't had the privilege of seeing Sophie do small talk, she's bloody good at it.
I'm quite good at small talk, aren't I?
You kept that guy on the phone for like 20 minutes just
That's right.
asking his wife and dog. I was actually quite enjoying the conversation. I was getting to know this guy who was on the phone. I was like really invested. It's kind of sad when it came to an end.
Yeah. And I'm pretty sure what we ended up finding out as well, because there was a little bit of guilt of like, we're really haggling this down. You know, this person wants to sell it for 480. And here we are quite far below that, you know. But then the person who had owned it had had it for 40 years or something and bought it for 33,000.
33,000. So yeah, they wanted more, but that reserve was not realistic.
Yeah.
Like for that property. I think that property was probably worth 450. So I think you got probably a 50 grand discount because no one else turned up to the auction. Like if there was competition, I think they would have sold for about 450.
Yeah.
Just looking at other properties. So you got a 50 grand discount, which is great.
It's probably the biggest discount I've ever had.
Well, it's amazing. That's the thing with property. Like just something like how long would it take you to earn in your job a pay rise of 50 grand? Years, right?
Unless you work in finance.
Yeah, years. Yeah, you get a nice bonus.
So basically we got it and then it was back and forth for like a while. And I kept being like, oh, this is too high, you know, and it was the whole like kind of, but wanting to let them feel like I was making an effort to meet them. Because I mean, also it would have been great to get it for even less, you know, but we kept creeping up and then we got to the point where it was like, yeah, this is literally the absolute max. Like we can't go any higher.
Yeah, correct.
And managed to get it.
Yeah, amazing.
God, it was good. Oh my God, that was such a euphoric high.
It really was. It wasn't even my money or property, but it's amazing just sharing that experience with you, especially because it was both your first properties. So that was really special to be a part of and share that
My
with
parents
you.
came like storming in the room. They heard the screaming. It was like a whole thing. Whoa, that was so weird. Bought a property.
Yeah, it wasn't that long ago, but it feels like quite a while ago because we've done so much with the property and stuff like that. I suppose one thing I'd touch on as well is that going in terms of advice around auctions and stuff like that, was going into that auction, we knew the vendor was quite motivated. So we knew that we were in quite a strong position if it did get to negotiations that they just wanted the property sold. And so that's a really important part to it, is understand your vendors. Do they really want to sell? If they're a bit iffy, if they want to sell, then you're probably not going to be able to get a deal. But if they've owned the property for 30 years and bought it for 33,000, do they really care if they sell it for 450 or 410? Probably not. They've made whatever amount, hundreds of thousands on it. So.
And that's a really good point. And we had Alex Harper on and she spoke about that too. It's like, it's not just about not blowing out your renovation budget. It's not just about like all the other things. It's actually really mostly about buying well. Like you want to buy well and you want to buy a property where you're not overpaying. Otherwise, that's already eating into the potential of on selling it for more, which I think is such a... It's so obvious when you know that, but when you don't know it, it's not that obvious.
Yeah, and it's that logical thought is even more hyperinflated with flipping, because you can't just hold on to it for 20 years and let time remedy your overpaying. Do you know what I mean? If you're selling that property in 6 months' time, then if you've overpaid, then it's pretty tough to make money on it. But
true.
But of course, you don't want to overpay in general, and even better if you can underpay like you did.
And I guess just to wrap this chat up, basically what happened was we underspent on our renovation, which is absurd. And like, honestly, most people say when you're renovating times everything by 3 and that's how much it's going to cost. So the fact that you had put that much due diligence and planning and actual precision around what we were going to spend, what we were spending it on, what kind of materials, like that's the reason that we hit our target, and we actually did even better than our target because we underspent on the renovation. But then when we had it revalued, so obviously we bought it for 400. Then we spent 73, I think it was, on the renovation. And then when we had it revalued, drum roll.
595, baby.
595. Yeah. So we made 125 grand in 5.5 weeks.
122, but same diff.
Same thing.
Same diff.
Give me a round up.
I think that's right, 122, yeah.
Which
Sounds
is pretty
right,
amazing. And so essentially what's happening now is we're trying to figure out if we can go again, if we can do exactly what you're talking about, which is using the equity.
The last part of the R.
Yeah.
So yeah, that was the goal going into it. I think I mentioned, as part of my, let's call it sales pitch, right at the start is, my goal for you and your mate, who you're not sleeping with, just to clarify,
it
people.
It sounds so dodgy, doesn't it? Yeah. My mate.
The goal was to do this first one and then get enough equity uplift that you're in a position to get one in the second half of this year.
Become a property mogul.
Fulfill your dream of becoming a mogul. And we've got the equity side of the equation sorted. Like we've now got enough for a deposit to recycle that equity out for...
Just explain how that happened though.
We haven't really touched on the refinance process, but we do the renovations and then we get a registered valuer to come back and they do that process that we talked about at the start. What is this place worth compared to other properties? And it's quite a process they go through. Like the report's like 20 odd pages, but the thing you care about is the value at the bottom. And they went through that process and valued it at 595 for you, which is an amazing result. So
such a good result.
15 grand more than what we thought, but I'd like to, in general philosophy, under-promise, over-deliver. I'd much rather have this conversation than, it's only worth 560.
Totally.
Do you know what I mean? So I'm always a little bit conservative on my numbers. You can get a valuer who maybe values it, like you could get this two different valuers and they may value it 30, 40 grand apart, which is a bit of risk. Do you know what I mean? And so I factor that into those, and that's why we have that range. Maybe you get one at the lower range, and one at the upper range. So we've got that valuation, and then the next step is going back to the bank and saying, "Hey, bank, this property is now worth 595. I'm allowed to borrow 70% against this property. 70% of 595 is insert number here. I can't do that in my head.
I think it's 135.
Well, that's the deposit we need for the next place. But borrowing 70% of the 595, let's call it 450.
Yeah.
You can now borrow 450. You take that equity and you use that as the deposit for the next house, which we need 130 grand. So we take out the 122 usable equity that or the 122 that you've gained, and you use that for the next place. And obviously you've got some cash which we can use to fund the renovations for that second property. So
basically what it means, like for anyone that didn't follow those numbers, essentially, it was well explained, Pete, but essentially it's the idea that for us now, we don't need another full deposit because we've got the value in the property. So now really, if we were to go for a similar priced property, what we actually need is the renovation money, which is like, let's say 80,000 if we went for a similar approach.
Well, you don't need the cash for the deposit. You don't need 130 grand sitting in your bank account. You can use the equity in your existing property as the deposit for the next place. And for the next property that we're looking for, it'll be around that $120,000 for the deposit.
Yeah. Which is similar, like probably a $400,000 house.
30% of 450, whatever that is.
And I just think, isn't that amazing? And so many people don't know that you can get property and make money in these regional parts of New Zealand, or wherever you're living. The fact that is a strategy that so many people don't know about. I'm just I know people who are aware of property and are quite involved in this space. Probably this is this is second nature to them. But it's so not democratized in that way. And I think that we're actually going to start a little just like a short list, because obviously Pete doesn't have a million hours in his week and he's already working on other projects. But in the Investing Club, we're going to start there's like a short list or a waiting list. So if you're in a position where either you have a property already that you could potentially loan against to go again and get like what we're about to do, like an investment property, or you haven't bought any property, perhaps you live overseas and you want to invest in the New Zealand property market, and you either can do it like me and my friend did and go for about 100, 110 in cash, or do it all yourself. It's in the Investing Club. Give us your details, and when Pete's in a position where he can take on more clients and work with people, then it'll just be first and first served.
Yeah, and that is just a side note. That is one thing I've noticed as I've progressed through my property journey, is how many people are actually in a position to do something. For people who own their own homes, they actually have enough equity in their own home to do something, but they don't realize, or they didn't know that you could use your equity in your home. And it's amazing. I have these conversations. Oh, I'd love to buy an investment property. And I go, oh yeah, what's your house worth? What's your mortgage? And and I'm like, yeah, you've got $500,000 worth of equity you can use, and they're blown away. So it is amazing. I mean, you have to have owned your own house for a while to get that equity, but if you've owned your house for 3-5 years, you've probably got enough equity in it to be able to do something. The next concern from people are like, well, how could I afford the next mortgage? And that's where buying the right property, that's cash flow positive. You're not going to have to top it up, which is sort of where, I brought you on that journey of like, hey, we're not going to have to put any of your money into this property. And once you realize that, you're like, oh, wow, that's great.
Like it runs itself.
Yeah,
it's its own little operation. We don't have to pay money to pay the mortgage down. We're not doing that. Pete, thank you so much. For anyone who's interested in working with Pete, find the details in the Investing Club, but also just like a public thank you, because working with you was like such a dream. Like, the most amazing comms, so much fun. Like the whole thing was just like a really empowering process. So thank you so much. Yeah.
My pleasure. Thanks for taking a punt. It was an absolute pleasure to get you on the ladder. On to the next.
Property moguls, here we come. Did you love this episode?
Yes.
Have you got property front and centre in your mind? Sounds like you're a 5-year-old.
I know.
Now could be the time to take the first step towards what it is that you're wanting to buy, whether that's your first home, whether that's a new flat, whether it's, I don't know, buying another investment property.
And thankfully, BNZ has the expertise and tools to help you get started, and their home loan partners are ready whenever you are.
You can book an appointment, you can ask millions of questions. Trust me, that is totally fine. And you can start turning the property dream that you have into a plan, and hopefully soon into a reality. I know from experience that this can feel quite overwhelming, but when you're working with experts who can actually help you get there, it's such a burden off your shoulders to know that you've got the advice and the tools that you need to actually make it happen.
We know how hard it can feel and like overwhelming and just, so like a fish out of water when it comes to buying properties. So we're so thankful to BNZ to be helping us create and empower this podcast so that people can learn, and we just want you all to succeed. We want you all to succeed. We're all in your corner, and this is going to be such a game-changing property podcast series.
Yes, and for anyone that is going through the process of either buying a house or a flat or whatever it is that you're trying to do, please let us know, because we would love to be cheering you on from the sidelines. But thank you so much again to BNZ for empowering this podcast.